Hello, good morning to everyone. Today we are going to discuss about the paper for PG students, Cost and Management Accounting. This paper contains the costing system, process costing, CVP analysis, standard costing and the financial statement analysis. We are going to discuss about one by one. In Unit 1, we have an introduction about the costing system. Basically, we know about what is cost and costing. So, cost is the value of manufacture or produce one goods or any service. Here, we have to discuss about the costing system. The main objective of costing system based on the determining product cost. That means if you want to manufacture a product, we have to find the cost. Then after that we can sell it to the consumers with profit. So we have to first determine the product cost, then assist in pricing decision. Based on the cost, we can add the profit percentage, then we can sell it to the consumers. The third one is control cost. That means suppose the price is high in the market, we can reduce it based on the cost control. So when you control the cost, the price of the product automatically reduce. The next one is facilitating budgeting and planning. Based on the previous data, we can prepare the budget and planning for the future activities. Then another part is what are the type of costing system. In cost accounting, we have a different costing system. The first one is job costing, then process costing, activity based costing, standard costing and marginal costing. We are going to discuss it one by one. In a costing system, before we start it, we have to install the costing system for a manufacturing company. The preliminary steps for installing costing system is study the business processes. That means what type of business the person doing. Based on that, the companies can set the costing system procedures. Then next one is identifying cost center. Which type of cost they incur, so they can prepare the costing accounting. And third one is select appropriate costing methods for that particular business activities. Then another part is how to implement the costing process. Then one by one, develop costing procedures and policies. Based on our business customs, we can frame the costing system and procedure. Then we have to give a training to the staff members because we have some procedures to record the costing. So based on that, the staff also must train it. So we have to give a training to the staff members to adopt that. Then third one is set up cost records and softwares. So when you record the costing system, we have to maintain some records for future activities. At the same time, we can use some softwares to record the data. Then we have some rules regarding the costing system based on the company's accounts. When you follow the Companies Act, as per the Companies Act, that means costing records and the audit rules, we have to maintain the cost accounting records. Suppose a company have a manufacturing unit, they have to maintain how they purchase the materials, they have to maintain the stores ledger, then we have to analyze the labor transactions, then we have to maintain the overheads cost. Then after that, the costing records must be include what type of material we consume. That means we have to maintain the stores ledger. That means how much of units we purchased, we use and sell it to the consumers. Then what are the remaining balance in our account. Then you have to maintain the labor and overhead allocations. That means labor here, what type of labor we employ, then how much amount we have paid as wages for that particular persons, then we have to maintain some overhead allocations. That means the direct and indirect expenses for manufacturing costing. Then another one part is inventory records, because the inventory is an essential element in the costing records. Based on the inventory, we can start our manufacturing process. So if we need inventory records for the purpose of how much of units or materials we have, how much of material we have to maintain for a period. Okay, another one is utilities and depreciation data. Then that is the main purpose of the machines used in costing records. Then another compliance requirement is maintain records in prescribed format. That means for each and every activity of manufacturing concern, you have to maintain the individual records. That means maintain the elements of, that means material, transactions, then labor and overheads. Then another part is how to control the cost. That means how to reduce the costing expenses. That means first one is budgetary control. That means based on the budget when we proceed, we can control the costing methods. Then another one is standard costing. When you analyze the standard costing, we can compare the actual and budgeted data. So third one is variance analysis. Here we can analyze what are the variance compared with the standard and the actual expenses. Then another one is responsibility accounting, then benchmarking, then we have some key indicators. Here, how to control the cost, that means by using wages control. The major element of costing system is, first one is raw material, then another part is wages. That means when amount paid to the laborers. So when you control the wages, we can automatically reduce the cost of a particular product. The another one is scrap management. So when you manufacture some product, we have some unused materials. That means we can sell it for scrap and we can realize some amount. Then we can deduct it from the costing records. So we can reduce the selling price. After one is spoiling control. That means before start the manufacturing process, the companies must follow some standards. That means without spoiling any material, we have to manufacture some product at the time of input of raw materials. The another part is when you use the trained employee to handle the machines and the material, we can automatically reduce and control the spoiling transactions. The another one is defective control. That means it's a root cause for analysis. That means the defective control is how to reduce some issues when you face the manufacturing unit. Right. In Unit 2, we are going to discuss about the product costing. Here, the definition for that, the costing methods are techniques used to determine the cost of product or services. Here, we can find the value of one product or any services rendered by the companies. Here, we have some topics going to cover here. Then the first one is product costing. Then second one is process costing. The third one equivalent unit. Then inter-process profit, just in time, and activity-based costing. We are going to discuss it one by one. Here we have some definition about the product. Then here it assigns cost to individual product is the product costing. For example, when you manufacturing one product, we have to use different elements. That means material, labor, and overhead expenses. That means when you determine one product cost, we have to add some materials, we have to engage some laborers to manufacture it. At the same time, we have to spend some money for as overheads. So the three elements it creates the cost of material, that means cost of product or cost of any services. Here we have given some example. Here a company manufactures 100 units, that means they are using material cost of rupees 500 per unit, then labor 300, then overheads rupees 200. Here we can find the total cost of product, that means 500 as a material, 300 for labor and 200 for overhead. You can find the value of one product is rupees 1000. Suppose the company manufacturing 100 units, the total cost of the material, that means the product is rupees 1 lakh. So based on the that means elements that we used in manufacturing material, labor and overheads, we can find the cost of one product. Then second part is process costing. That means the companies having manufacturing one product in different process, they have to follow the type of accounts. When the companies have a different process, they have to follow this costing methods. Here we have given definition about that. Used when product is continuous and the products are indivisibly the same thing. The chemical industries, cement and the paint industries use this type of costing methods. Then for example, here we given some illustration about the costing system. The input of 1000 units as a material, then here we given cost of rupees 10,000 as a per input, then normal loss is a 10%, output is 900 units, the scrap value per last unit is rupees 1. Here, when you prepare the process costing, we have to calculate the how much of cost in debit side. At the same time, in credit side, we have to deduct the normal loss. After that, we can find the exact cost per unit. Here, for example, here effective units here is 1000 units is the input. Then again, we given a normal loss 10% on input. So we have to deduct the normal loss 10%. 1000 units minus 100 units, we can get the exact actual output is 900 units. So here is some scrap value for 100 normal loss units. The scrap value of per unit is rupees 1. We can get the realized value for scrap is rupees 100. We can get the net cost of product. Here the total cost is 10,000. When you realize some normal loss, we get some additional amount of 100 that we can deduct. We can get the 9,900 as the process cost value. Then we can find the cost per unit based on the total cost divided by number of units they produce. That means here we can find the cost per unit. 9,900 rupees is the total cost. Then the way to find the means to manufacture 900 units. The value of one cost per unit is 11 per unit. Is the process costing method. Then another part is treatment of equivalent units in the costing. So when event is used, that means units are partially completed. Suppose the company manufacturing some product, some part of work is completed, the remaining is incomplete, that is a work in progress. So we can find the treatment of equivalent units. Here we have some formula, that means equivalent units equal to actual units into percentage of completion. That means how much of they complete their work. We can find the equivalent units. Here we given some illustration about that. Here 1000 units is completed, then 200 units 50% completed. Here the material 100%, labor or overheads 50%. So based on that we can find the equivalent units. Here have some solutions. Equivalent units for material, that means value 1000 plus 50%, that means 200 units completed. Then we can find the 1200 unit equivalent units for conversion means 1000 units completed units plus the how much of percentage completed in the units completed, that means 200 units is a 50%, so it's an 111, that means 1100 units. Next one is inter-process profit. When the companies manufacture some units, they transfer it to the another process. When they transfer the process to the product, then we can fix the some percentage of amount as a profit. Here have a concept. Here what is the inter-process means? Profit added to goods transferred from one process to another. That means I already said. Then what is the main objective is to evaluate efficiency and the responsibility of each process. That means without making any process, if you transfer it to the another process, have no profit. So we have to transfer the one process value count to the another process. We have to fix some percentage as a profit. Here we have some illustrations. In process 1 cost, it's a value of rupees 20,000. Profit added, that means the 20% on cost, that means on 20% on 20,000. So the transfer price is 20,000 process value, then plus 20% on cost is a profit. So the companies, they can transfer the product from one process to another process is rupees 24,000. So it's the main concept of inter-process profit. That is, the companies transfer one process to another process, they fix the percentage of profit on the process cost. The another part is just-in-time costing. That means many companies, they maintain the materials in their stock. So to reduce this some cost, that means reduce the cost, then spoilage of material, we have to adapt this type of method. Then first one is just in time. By using this type of method, we can minimize the inventory. That means when we need, we can purchase the material, otherwise no need to purchase and dump it. So no or minimum inventory, they have to have some cost reduction. That means when we need a product we purchase, we can reduce the circulation of money. At the same time, waste elimination. That means without unnecessarily, if you are not ready to purchase, you can reduce the waste. Then here, what is the main impact of this is cost are recorded when the incurred traditional inventory accounts may be eliminated. Okay, you are not necessary to maintain the type of accounts. Just when you adopt this type of just-in-time costing, when we need, we have to purchase it. Otherwise, no need to purchase any material or engage any labor. Okay. Then the next part is activity-based costing. Here, the main definition of that, allocate overheads based on activities that derive cost. That means here we have some steps to find the activities-based costing. First one is identify activities. What type of activities they completed. Then another one is determine cost drivers. The third one is assign cost based on the activity usage. That means we have some visualization. The first one is the main activity that given is maintain, that means machine setup. So the companies that means machine setup, the cost of the value is rupees 50,000. The cost of driver, that means 100 setup. Then product A 40 setup and product B 60 setup given. Here we can find the activity based costing for product A, and the cost drive is 100 setup. They completed only the 40%. So we can find the value of 50,000 and 40%. So the product A is activity based costing is 20,000 as it is. For product B completed the 60 setup. So out of 50,000 they have to complete the nearly 60%. That means totally A and B we can find the 100. So the part of product B is setup is 60. So you can find the value of 30,000. So based on the product A and product B, we can find the based on the activity completed the cost of product. I have some conclusions about that particular topic. Here, the product costing based on the job-based manufacturing. That means the company wants to find the cost per unit or cost of product, they can use it. Then another part is process costing. It's a continuous process. They have some cost per process stages we can find this. Suppose the company is having a different stages, we can find the each stage's cost per unit. So third one is equivalent units. Which type of industry use, that means partially completed units we can find the value. Same time as used for calculates cost for in process items. Then another part is inter-process process profit, that is it used in multi-stage production to measure the performance at each stage. Then another part is just-in-time JIT costing, lean manufacturing. That means without using more money for dumping material, we can use the type of method. The last one is ABC costing, that means activity based costing. It is used in multi-product firms based on the which type of activities they completed. In Unit 3, we are going to discuss about the cost volume profit analysis. That is, here we given some analysis about the definition. Analysis how cost and volume affect the profit. Okay, so how much of cost, how much of volume affect the profit of the particular product. Then here we have some assumptions. First one is cost are classified into, that means fixed and variable. We already know that. So cost based on that we can fix it. Fixed and variable. The fixed means there is no, that means have a constant. That means variable means it depends upon the production, the cost may vary. The next one is sales price and cost remains. Then another part is constant per unit. Then here are some formulas, key formulas. Here in CVP analysis, break-even point. That means here the break-even point we can calculate based on the number of units manufactured to reach the no profit, no loss stage. At the same time, we can find it in volume. That means in rupees. So to find that break-even point, we can find the units based on that. Break-even point in units, you have formula fixed cost divided by contribution per unit. Here, contribution means is a difference between the sales and the variable cost. If you want to find the cost per unit, you can find the difference between the selling price per unit minus variable cost per unit. So we have a formula break-even point equal to fixed cost divided by contribution per unit. Here we have some information about the profit. That means here we can find the profit based on the profit statement or marginal cost statement. When you take it as the sales less variable cost, we can find the contribution. From that, if you deduct the fixed cost, we can find the value of profit. Here we have given a formula. For example, we given one illustration. Here selling price per unit rupees 50, variable cost rupees 30, then fixed cost is 20,000. So next we have one solution. Here break-even point is, that means fixed cost we given it 20,000 divided by variable cost per unit rupees 20. That means we find the variable cost contribution, that means 50 minus 30 is we can find the value of contribution 20. So we divide it by from 20,000 we can find the 1,000 units. That is the break-even point. That is no profit, no loss stage. So we can find the profit of that particular unit. We can find the profit at that means the break-even point is 1,000 units. When you find the profit at 1,500 units, that is the value of profit. We can find that 1,500 units in the selling price per unit. We can find that contribution per unit, that is 20. Then minus the fixed cost, we can find the value of profit is 10,000. That means when you compare the break-even point and actual, we can find the margin of safety.